Hey gang, welcome to Dr. Frank's Finance World. I am Dr. Frank the Bank because I try to teach you something about finance and help you put more money in the bank. Please be sure to subscribe or do notifications if you're interested in more videos in the future. I think there'll be plenty out there. Check in the notes and at the end of each lecture or each video, whatever, about the websites and some places that we've gone. And then check out our books and the links for the Amazon bookstore. They are my favorite for each topic level. So I'm going to review Bollinger Bands real quickly one more time on the next slide, but really relative to this point, there are the upper, lower, and the middle bands, but I've seen some articles and books, including my favorite book, Bollinger on Bollinger Bands, where he tries to draw relevance to the channel widths, and it kind of looks like this. And I've actually done this many times before and looked at these from different aspects and all this. I don't see where the relevance is in this, to be honest with you. I've looked at the widths of the bands and all that kind of stuff, and it hasn't done a thing for me. So I don't know. It is true, I suppose, that when the stock gets more volatile, the standard deviations get wider, and therefore you get more of a movement in the bands and so forth, or a width of the bands at least. But I haven't seen where that can lead to a positive up or down one way or the other. So just trading rules as well, because I want to emphasize this down here when we talk about discipline is probably the most important thing as a trader, as an investor, period. You have to be wise enough to sort of see if what you're using works or not. But at the same time, you have to have the fortitude to say when it's moving against you, I'm smart enough to get out when the time comes, but more importantly, I stick with what I've got and what has been the tried and true for a long period of time. So for me, the combination of the relative strength being below 30 here and getting the Bollinger Bands above the Bollinger Band is when I will actually buy, or below the Bollinger Band as well. I buy both of them on the bottom side. And then I didn't mention this before, but I wanted to mention this now. I check for new information. Anytime it goes down 10% and goes below the lower Bollinger Band, I always comb through everything I can to get information on the company, because I'm like, well, has the market heard something or read something that would change my mind fundamentally about the products or where they're headed or anything like that? If not, I will buy it again when it's 10% down or more, and another buy signal of a below the Bollinger Band relative strength does it. And I will do it again a total of 3 times. Each time I check for new information. On the 4th time out there, though, I sell, because in the end, I'd rather have some money to come back with. And I also sell when the current price is above the upper band and relative strength is above 70. And I sell that every single time. If I was honest down here, when you're talking about this kind of an area down here, ultimately you're finding that the market does actually tend to hit a low on the day after the first signal about midday. That's the best I can give you on that. And these were never really meant to be buy sell signals for me. It was meant to be, it's kind of cheap and everybody hates it, or it's kind of expensive and everybody loves it, and I'm kind of a contrarian investor out there. So that's how I look at this modeling when I go through it. Anyway, but the discipline is really the key for any type of investing out there. That's how you're going to keep yourself out of trouble and away from the biases and stuff that we'll talk about in today's research. So I use daily, and I pull up the charts for 13 months, like I said, to get outside of cycles. I have, before actually using Excel, sensitize the model by changing the number of standard deviations. For some companies, it works better not at 2 standard deviations, but maybe buying at 1.7 and selling at 2.2. And there's a way you can do that. I can get into in a later lecture if somebody's interested. But basically, the problem is data fitting. Is it going to work? You made it fit exactly for a time period. Does that mean it's going to be less of a predictor going forward? For day trading, I also use 15-minute intervals, and a very similar process out there. When we get to the meme stocks here in the next lecture, I'll talk to you about that. So I do have a stock charts triple ETF that shows you. I pulled this up just to show you that what happens when you get it still, you can see that you get a little better picture of it when you put it over a shorter time period. You see down here, it's only going from May down here to end of October and so forth. And at any rate, this is probably home building and that type stuff, but it's talking about, you didn't buy, you finally bought down here when it hit a price of probably 20 or 21, And you didn't sell up here, but you thought about it pretty hard. It went up on the Bollinger Band and got pretty close on the relative strength. Given that this went from 20 to probably up here is probably what, 39, you doubled your money in the span of about a month. I probably would sell. I mean, I have a goal in mind on a lot of these, and if I can make 30, 40, 50% on it, I'm good. I don't have to do perfect Bollinger Bands or anything. I pocket the money and run. But at any rate, and it's recently got down near lows again, not from the Bollinger Band standpoint, and it looks like the market is forgiving the home builders. So there's other ways to look at it, and I figured this out. I've taught a lot of investment classes, and I've gone to something that's called Business Spreadsheets up here, and it actually is the Excel program. You can go get, you can download it for I think 30 days for free. And I have my students put in the portfolios of 10 securities they have, and then it looks at it from what they currently own and what if it was optimized compares to the S&P and so forth. But there's this total return comparison tab that's part of one of the Excel tabs, and it actually shows what would happen if you optimized it using technical analysis. And I'll tell you again and again and again, even though, like I said, the research will beat on a little bit, and I've literally looked at 1,000, 2,000, 3,000 portfolios, it has won the vast majority of the time. And this is kind of the screen that talks most about technical analysis. Like I said, you can go there and look it up yourself if you want, but this says whether, simple moving average or MACD or relative strength of Bollinger Bands, whether for each individual security, I had to hide those over here, FINRA thing, they actually, by pass, it means it beat a buy and hold as opposed to not. That's what fail is. Interestingly, this happens very, very frequently, that Bollinger Bands do actually beat it. And you can get quite a different value added, another 15% over this 5-year time period by using some of this type, and it doesn't interlace relative strength either. So just another interesting sign that perhaps you can get some help from it. Anyway, so the books, once again, I'm going to give you the free one there is the Bollinger Band Strategy Download. It's a PDF manual. When we look at analysis, I went to Seeking Alpha, an article there from interesting guys, been around a long time, as well as another one on a research front out there. But let me hop out of here. And we can actually go to what those look like over here. So the why technical analysis doesn't work. And he isn't, the interesting thing, you have to read through here for quite a bit. He doesn't say that it can't work or that it doesn't work in certain situations. What he says is, and this is what I try to get through with the bias and stuff, people tend to find a system or a number of standard deviations or whatever that would have, based on what they looked and kind of what they think, would have made them money in the past. And that's actually not the way to look at it. That's why the discipline comes in. But you can read through down here, and he talks quite a bit about it. Trading to evaluate. He doesn't look at it. The problem is twofold: data mining bias. That's what happens when essentially you look for years or situation or stocks or whatever that work. Coupled with this is why it's so important to me that I have the trading rules associated with relative strength and Bollinger Bands, because it says the subjective interpretation of the data is the problem. Basically, people changing their mind and deciding it's going to be this, or hey, it kind of looks like this, or that almost looks like. That is actually probably going to get you into more trouble than not. And never forget, in my honest opinion, it's actually fundamental analysis first. It's looking at the economy, layering that onto fundamental analysis and getting the companies and the sectors and the industries that I want. And then I evaluate the firms and the fundamental analysis and say, these are my favorite. And finally, I will roll technical analysis as the icing on the cake on top of that. So here's another paper that came out, a trading strategy based on wavelet analysis. I probably couldn't describe wavelet analysis as a math technique to you, but suffice it to say that everything years ago was bootstrapping, where they ran iterations of the data based on what it kind of was and what distribution you thought it was, and sort of came up with results that way. And then they got to factor analysis, where these factors mattered, and that's where, when we get to the stock part of this, when we talk about anomalies, that's where all that came from. Neural network has been the interesting one now, because for factor analysis, it freezes all the other variables and then looks at one independently. Neural network puts them all together. But as the math changes, and this is sort of my point, it's kind of interesting how the story starts to change. It says, takes a stock index in China, and sets up the Bollinger Band strategies. No relative strength, while considering the returns, retracement, blah, blah, blah out there. Furthermore, the paper uses the wavelet noise reduction to process the data of price, and the Bollinger Band trading strategy to test the processed data. Compared to the results of the first test, the Bollinger Band trading strategy on wavelet analysis has greater returns, less risk, and better applicability. So sometimes transforming the variables gives you a different picture of what's going on. So anywho, my tip once again is to layer them. You can check out MACD. We'll have a video on that in the not too distant future as well. And then to look at possibly changing, my favorite sensitivity analysis probably is changing the relative strength from 14 days to 12. And keep in mind that the people involved in a given security issue, mutual fund index or whatever, they sort of drive what happens fundamentally, what's going on. And sometimes those people change. The big guys go away and go do something else. And so you do see sometimes some changes that are worth at least paying attention to out there. So please don't forget to send emails with comments and suggestions. And appreciate you guys. Have a great day. Hope this helps a little bit. See you later. Bye-bye.